Welcome back. I'm Peter St. Onge. This is a weekly roundup of my daily videos on the economy and freedom, where I cut through the BS and lay out what the gaslighting clowns pulled out of their hats this week and what is coming next. The entire world is going populist, so says the Financial Times, with Zero Hedge summing it up. Quote, in 2024, democracy spoke and it roared with anger. The evidence is a new analysis finding that for the first time since 1900, votes fell for every single ruling party in an advanced country. What's driving the anger is three things: the economy, immigration, and a social media that is letting voters hear what's actually happening in their countries. On the economy, I've mentioned wages that failed to keep up with inflation. This is leading to a plunge in social mobility, as the rich find ways to dodge the falling boulders, but the poor get wiped out. This combines with immigration to decimate the working class, as it turns out importing the third world also imports third world wages. In raw numbers, out of 12 elections in advanced countries last year, the party in power lost, on average, 7% of the vote. Now, 7 points in politics is a big deal. It's the difference between a win and a landslide loss. Where did the voters go? To the populist right. Nearly 90% of the gain was on the right, with a smattering of voters going to the radical left, presumably disappointed in a crony left-wing elite that sold them out to globalist corporations. The swing was massive among the young, who are turning en masse against the entire system. The biggest swing was young men, so most American men actually voted for Trump. That's up from just 1 in 3 traditionally voting Republican. This is turning Gen Z right, an echo of the increasingly right-wing Gen X. In Europe, it's even more extreme, with right populists going from 20% of the young male vote in 2014 to nearly 60% today. Even European women went from 20% in 2014 to nearly 40% now voting right-wing populists. In other words, young Europeans are now significantly more right-wing than young Americans. In fact, if only young Europeans voted, Europe would be substantially to the right of Donald Trump. So what's next? We are witnessing a realignment, a complete rejection of the center-left globalists who've misrun the West for a generation, with economy and mass immigration the tip of the spear. Now that Trump has liberated America, and even Canada looks like its long nightmare might be over, attention is turning across the pond, where a savior is haunting Europe, the savior of populism. First up will be Germany, with elections due in February, where the right populist Ph.D. is second in the polls, the first time in 80 years for an outside party. Meanwhile, polls show the left-wing governments of Australia and Norway are on course to lose power in the coming months, with Poland, Czech Republic, and Ireland all facing voters, no doubt, with trepidation. In some countries, the government is so unpopular they could actually have early elections, one poster child being Britain, where communist groomer Keir Starmer is now scoring just 25% in the polls, mere months after taking office. Elon Musk recently posted that while Donald Trump was a big win, we are not safe until the entire West is liberated. The next 12 months is our chance. Joe Biden is handling Donald Trump a lit fuse on inflation. Like a zombie who refuses to die, Bidenflation just keeps going because federal spending just keeps going. Last week, the Bureau of Labor Statistics released new CPI numbers showing inflation jumping to an annualized 4.8%. That's up 5.5 points in just 6 months, nearly the pace of the worst of Bidenflation. So consider that just 6 months ago we had deflation. It was an innocent age with the front pages of America bespeckled with celebrations how Bidenflation was over. As Paul Krugman famously wrote, quote, "We won the war against inflation at very little cost." Of course, there was enormous cost, but it was blue-collars struggling to feed their kids, not the people at Paul Krugman's cocktail parties. Problem is, even with the cost, we did not, in fact, win the war against inflation. So what happened? Simple. The federal government never cut spending, which made it impossible for the Federal Reserve to fight inflation. The problem is the federal government, both parties, is addicted to spending. It's how they pay their donors, how they pay their activists, it's how they buy elections. As for the Fed, before June, they had been bringing down inflation by selling their enormous hoard of assets, the Fed balance sheet. But in June, they stopped. To see why, when the Fed wants to print money, one way is to literally type a bunch of ones and zeros on an Excel sheet, pretend it's money, and then use that money to buy everything in sight, mainly federal debt and mortgages. This is called quantitative easing, or QE, and the proceeds go on the Fed's balance sheet. It's their assets, the proceeds of the Fed's counterfeiting. Now, during the pandemic, the Fed typed a lot of zeros. Their balance sheet went from $3.8 trillion before the pandemic to almost $9 trillion by the peak of Biden inflation. So $6 trillion created out of nothing. Alas, all that printing went directly into inflation. To cancel that inflation, the Fed reversed to selling those assets, called quantitative tightening. So they would sell, say, government bonds and just cancel the dollars. They vanish. In fact, they were selling over $60 billion of federal debt per month, which was canceling Biden's deficits, up until June, when the Fed slashed sales by half because they were getting nervous that deficits were getting so big, financial markets couldn't handle them. And so, in just 6 months, we went from negative 0.7% inflation to 4.8%. So it's next. With Biden looting the Treasury and the Fed having bowed out, Trump is walking into an inflation wood chipper. He'll need fast growth, and he'll need fast spending cuts to curb Biden's inflation. Now, Trump's asking for all the right things from Congress, tax and regulation cuts for growth, along with drill baby drill, and spending cuts with DOGE, the Department of Government Efficiency. But Congress will not feel the pressure unless voters understand that it's congressional spending that is keeping the inflation going. A word from our lead sponsor, Unchained.com. It's time to think about your annual IRA contributions. And the IRA is an investment vehicle that can save you a lot of taxes. And with Unchained, you can hold real Bitcoin in your IRA, get access to trading, inheritance, and loans. And it's the only company where you hold the keys and can verify that your Bitcoin is not being relent like banks do. We've seen futures-based ETFs underperform holding your own Bitcoin, so why settle for less? Book a friendly consultation at unchained.com/IRA. You've heard me talk about the need to protect yourself from inflation and central bank currency debasement. Instead of parking your wealth and eroding dollars, there's an alternative: saving and earning interest every month in gold and silver with monetary metals. Gold and silver owners can earn between 2 and 4% on metal leases paid in more ounces of gold and silver. Accredited investors can earn up to 19% in monetary metals, precious metal bond offerings. That's real, tangible wealth, earning interest every month. This is more than just preserving your wealth. This is growing it in gold and silver that cannot be devalued by the Fed. Visit monetarymetals.com/Peter to learn how to put your gold and silver to work today. Now back to our show. The dollar share of global reserves just hit a 30-year low, as central banks around the world pile into other currencies and, above all, gold. Is the world walking away from the dollar as global reserve currency? Will we be buying our toasters with gold coins? The data comes from the IMF's quarterly COFR report, which measures central bank reserves. Now, central banks hold these reserves to manipulate their exchange rates, typically to weaken them to promote exports, but not weaken it so fast that they crash their banks. Reserves are also a safety net. They're liquid assets if central banks get into trouble, which many do, from Egypt to Ethiopia to, until very recently, Argentina. Now, traditionally, these have overwhelmingly been U.S. dollar assets, so federal debt, corporate bonds, stocks. This because these are big markets and the dollar is the most liquid asset in the world. Put it together and you pay very low commissions to buy and sell dollar assets. As a bonus, the Fed was traditionally thought to be more prudent than most of the world's central bankers, so, say, Egyptian central bankers could sleep easy with dollars. And yet the IMF report found the dollar's share of central bank reserves has fallen to 57.5%, the lowest since 1994. Now, before COVID, the U.S. had been slowly losing share for decades, bleeding out as central banks diversified into other assets like the euro, the yen, or itty-bitty currencies, typically trading partners or next-door neighbors. And, of course, gold, in an interesting central banker vote of no confidence in paper money as a whole. This slow erosion took dollar assets from 85% of reserves in 1977 to 71% in the year 2000, and then down to 62% in 2019. And then came COVID, which positively opened the floodgates. The dollar dumped 6 points in just 5 years. For perspective, that would put the U.S. dollar on track to below 50% of reserves in another 6 years. So why did it collapse? Two reasons. Loss of confidence in the Fed, as in COVID showed the Fed is no better than anybody else at handling inflation. And second, sanctions. Specifically, the seizure of Russia's central bank dollars, which put central banks around the world on notice that their dollars are not as good as gold. In fact, they're only as good as Joe Biden's handlers' willingness to not seize them. So what's next? Interestingly, one alternative to the dollar that is not gaining share is the Chinese yuan. In fact, its share is down almost a third since 2022 when the Chinese economy went stagnant, even as the rest of the world recovered from COVID. Meaning, so far at least, it will not be China that dethrones the dollar. It will be the mediocrity of the Fed's handling of inflation with a growing assist from gold as insurance that even central bankers think is worth buying against a falling dollar. As for the long game, the fastest way to put the dollar back on its throne is end the government deficits, reduce spending in Washington. A balanced budget tells the world the U.S. will pay its debts and won't inflate its way out of trouble. That, of course, is going to depend on Congress doing the right thing, an adventurous assumption in the best of times, and it adds one more big stake riding on Doge's spending cuts. The corporate racism industrial complex is teetering, which would be excellent news for the millions of blue-collar whites who have been its main victims. In a recent interview, newly based Mark Andreessen asserted that just about the entire Fortune 500 is in blatant violation of laws against racism because they discriminate against whites. And with Trump's win, they're now facing a Department of Justice that probably will not be looking the other way. Now, Americans overwhelmingly reject racism in employment. The most recent polling by Pew found 74% of Americans say hiring should only be on qualifications, even if it reduces diversity. Interestingly, nearly two-thirds of blacks and two-thirds of Democrats also say hire on qualifications, not on race. Nearly three-quarters of Hispanics, whites, and Asians say ignore race as well. This is emphatically not what corporate America is doing. An in-depth article by Bloomberg tallied up hires in the year after the BLM riots, finding that out of hundreds of thousands of hires by big companies, just 6% of the jobs went to whites. Note, whites make up 60% of the American population. So at face value, roughly 9 out of 10 white candidates were discriminated against based on race. And the victims were overwhelmingly blue-collar whites. So among executives and managers, whites were hired about half their share of the population, but among non-managers, they got just 4% of jobs, 1/15 their share of the population. For blue-collar jobs, whites actually lost jobs. They were down 19,000, even though 176,000 jobs were created. Interestingly, blacks and Hispanics got only their population share of top positions, but they got fully 90% of blue-collar positions. In other words, corporate racism wiped out blue-collar whites. The alleged sins of white privilege were paid not by the rich, but by the distinctly non-privileged. Happily, we have a government agency that investigates racial discrimination in hiring, the Equal Employment Opportunity Commission. It commonly uses statistics to find what's called disparate impact, seeing if racial shares reflect the population. In recent years, it's used this to go after companies for non-white discrimination, typically settling for tens of thousands per discriminated candidate. Applying that to potentially millions of white victims, it comes to potentially tens of billions of compensation owed for that institutional racism. Of course, even tens of billions would not make it up to the victims whose careers were cut short or who struggled to feed their family because they were unfortunate enough to be the wrong race. So what's next? Even before Trump's win, companies were already ditching their DEI discrimination. Right-leaning activist Robbie Starbuck has been great on this, exposing racist practices at companies like John Deere, Walmart, and Toyota. But with Trump's win, corporate America is now on notice. The EEOC itself will retain a Democratic majority until 2026 when Trump gets to appoint new commissioners. But the Department of Justice Civil Rights Division can also go after companies for racist hiring practices, and Trump has appointed firebrand Harmeet Dillon to do just that. Institutional racism has infected corporate America, victimizing poor whites by the millions. Its days are numbered. A word from our sponsor. If you run a business and want to get customers excited about your loyalty and rewards program, you can now implement Bitcoin rewards with Oshi Loyalty. You get all the perks of a full-featured loyalty and reward program with real Bitcoin rewards every time your customers shop, refer, and engage. Boost customer retention, loyalty, and lifetime value. And if you're looking for Bitcoin rewards when you shop, check out the dozens of companies in the Oshi marketplace at Oshi, that's OSHI.tech/shop. Start earning Bitcoin today. Now back to our show. America faces a, quote, last chance to grow out of our debt before we plunge into European-style stagnation. So says Trump's pick for Treasury, Scott Bessent, who, Senate willing, will be replacing Janet Yellen. Now, Bessent's not wrong, with the national debt set to hit $37 trillion in the next couple months, almost a third above the World War II record as a share of GDP, and with debt service now hitting $1.4 trillion, triple over the past couple years. Meaning nearly $1 in $3 the federal government currently collects goes straight out the back door to Wall Street and China to service old debt. Now, growth has been a central promise of Trumponomics, the key elements being lower taxes and regulations, more energy-friendly and manufacturing-friendly policies, low inflation, and with the Department of Government Efficiency, lower federal spending. If these can achieve, say, 3% growth and Doge can at least balance the budget, then the debt starts to proper melt away. To see why, it's not the amount of debt that matters, it's the size of the debt relative to the economy. For example, $1 trillion in debt is not a big deal if you're America, but it's crippling if you're, say, a tiny country like Iceland, where $1 billion is huge. So if you simply hold your $36 trillion debt in place and grow the economy 3%, you've effectively paid off 3% of the debt, $1.1 trillion. Do that for a decade or two, and we are out of the woods. Now, the last time we managed high growth and zero deficits was the late 1990s. The reason was Bill Clinton and House Speaker Newt Gingrich could not agree on anything. They despised each other. The only thing they did agree on was not spending money. Now, back then, they turned a deficit of 1/6 of tax revenue into a surplus of 1/6 of tax revenue. So that's equivalent to going from a $1 trillion deficit to a $1 trillion surplus. Of course, the spending miracle ended with 9/11 and the dot-com crash, which George W. and the drunk sailors in Congress turned into an even bigger deficit in just 2 short years. Still, note, Clinton did not even do the rest of Trump's growth agenda, so Clinton had no love for fossil fuels, regulations got much worse, and that sent manufacturing fleeing to Asia. The only bright spot in the 90s was the spending, and apparently that was good for nearly 4% real GDP growth across the decade. Incidentally, in the following 8 years, once W and then Obama wrecked the deficit again, real growth dropped in half to just over 2%. So 4% growth with shrinking deficits, 2% when the government gets hungry. So what's next? After 4 years of Biden's stagflation, the American people need growth. And they want the things it takes to get growth. I mentioned a recent CNBC poll that 73% of Americans want lower government spending, 78% want lower taxes, 3/4 want deregulation, lower business taxes, and more oil drilling. The challenge, of course, is Congress, because almost everything that grows the economy shrinks Congress's power. So the good news is the people are on our side. There's a way out. The bad news is it will take superhuman pressure to get Congress to do the right thing. If by some miracle they do, we can pull back from the abyss the Uniparty drove us right up to. Thanks for tuning in. Remember to subscribe so you don't miss an episode, and go to petersanons.com for daily videos and in-depth articles with charts and all the gory details. Okay, we'll be watching. See you next time.